Trading strategies. In the vast realm of financial markets, trading strategies play an instrumental role in guiding investors and traders towards their financial goals. These systematic plans, grounded in analysis and research, serve as a roadmap to making informed trading decisions. This lesson delves into the essence of trading strategies, their significance, and the blueprint to construct one. What are they? Trading strategies are systematic, actionable plans designed to guide traders in buying and selling securities in the markets. These strategies are anchored in specific criteria derived from historical data, technical analysis, fundamental analysis, or a combination thereof. Types of trading strategies. Scalping, a strategy that involves capturing small price gaps created by bid-ask spreads or order flows. Swing trading. This focuses on capturing the swing or change in momentum of an asset's price. Position trading, a longer-term strategy where traders hold positions for weeks or even months. Day trading entails making multiple trades within a single trading day, with all positions closed by the end of the day. Criteria-based. Every trading strategy is rooted in certain criteria that must be met before executing a trade. This can range from specific patterns in technical analysis to particular financial metrics in fundamental analysis. Objective-driven. Strategies are tailored according to specific objectives, whether it's short-term profit, long-term growth, risk mitigation, or any other financial goal. How to build a trading strategy. Constructing a robust trading strategy requires methodical planning, research, and testing. Here's a step-by-step guide. Define your goals. Are you looking for quick profits through day trading or a long-term return via position trading? Your trading objectives will shape the foundation of your strategy. Select your trading style. Depending on your goals, risk tolerance, and time commitment, choose a trading style that aligns with your objectives. Identify tradable assets. Depending on market knowledge and interest, decide on the assets you wish to trade, be it stocks, forex, commodities, or any other instrument. Choose analytical methods. Decide whether you'll rely on technical analysis, fundamental analysis, or a mix of both. This will dictate the indicators and tools you use. Set entry and exit points. Determine the criteria that must be met to enter a trade and the conditions under which you'll exit, whether it's for profit or to minimize loss. Implement stop loss and take profit levels. Decide beforehand the maximum loss you're willing to bear and the profit at which you'll sell your asset. Backtest your strategy. Before deploying your strategy in real-time markets, test it using historical data to see how it would have performed. Keep a trading journal. Document all trades, the rationale behind them, and their outcomes. This will help in refining and improving your strategy over time. Regularly review and adjust. No strategy is perfect. Regularly reviewing performance and adjusting for market changes or shifts in personal goals is essential. For example, a trader interested in short-term profits might opt for a day trading style, focusing on technical analysis and targeting volatile stocks. They'd set clear entry points based on specific chart patterns, have defined stop-loss levels to protect capital, and exit points to lock in profits. Conclusion. Trading strategies, while diverse in nature, all share a common purpose: to provide a structured approach to navigating the financial markets. Building and refining a personal trading strategy is a journey that requires patience, discipline, and continuous learning. By understanding the core principles and tailoring a strategy to individual goals, traders can bolster their chances of achieving consistent success in the market.